Okay, so welcome to my next video, which is about an overview of the audit. That is, what happens on an audit. You may have noticed that in previous seminars, we looked at more general topics relating to the auditing profession. So in seminar number 2, for example, we looked at the economic benefit of having an audit, how an audit reduces information risk. In seminar number 3, we talked about auditor independence issues. What does it mean for auditors to be independent? What are the independence requirements for private company audits compared to public company audits? And then in seminar number 4, we looked at issues relating to the Sarbanes-Oxley Act and the PCAOB. Okay, so again, very much general issues. But in this seminar, we're now going to start to talk about what auditors actually do during an audit. Okay, what are the learning objectives for today? First one is to outline the main stages of a financial statement audit. That I will cover in today's video. Secondly, explain the financial statement assertions for transactions and account balances. What should an audit firm consider before accepting a new client? Why do auditors assess internal controls, and what's the relationship between the auditor's evaluation of internal controls and substantive testing? Okay, so those are the learning objectives for today's seminar. What is the reading for today's seminar? Well, you should read the class outline as always to see what the questions are going to be in the class. I'm now recording this introductory video that you're listening to, and Chapter 6 of the Aarons, Elder, Beasley and Hogan textbook, Auditing and Assurance Services. Okay, this is a useful chapter for you to refer to. There are going to be 2 questions that we cover during the seminar. The first one is about the difference between reasonable assurance and absolute assurance. So why are auditors responsible for reasonable assurance but not responsible for absolute assurance? And what are the differences in the way that auditors are responsible for discovering different types of errors or frauds that may occur? So what are their responsibilities in terms of material reporting errors? How about material reporting frauds? And then thirdly, what about illegal acts that don't have any direct effect on the financial statements? Okay. So that's question 1. Question 2 is about the relationship between audit assurance and a client's internal control effectiveness. Okay, so for this question, in part A, I'm asking you, what are the differences between point C3, C2, and C1? Okay, so we'll talk about that in class. And then part B is explain the logic for the relationship between substantive testing and internal control effectiveness depicted in the above figure. Okay, so for example, what does it mean to be at point A here compared to point C compared to point B? All right. So that's question 2, and then we'll move on to multiple choice questions and to finish off the class. I have quite a few multiple choice questions in today's class. Okay, so to start off with, I'll talk about the main stages in a financial statement audit. So there are 5 key stages. The first one is client acceptance and the engagement letter. So this is where the auditor decides that they'll accept the client as an audit client, and then they will write an engagement letter to the client, which forms the basis of the contractual agreement that the audit firm is going to provide services to the client during the year. So that's the first stage. The second stage is to plan the audit. Third is to test and evaluate internal controls. Fourth one is substantive testing. And then the 5th one is completing the audit and issuing the audit reports. Okay, so normally an auditor will do all 5 of these stages. However, there is one stage that is not necessarily performed, and that is stage 3. Okay, so for some clients, an auditor may do steps 1, 2, 4, and 5, but not step 3. And that would be the case, for example, if a client doesn't have any internal controls, or the internal control system is so weak that the auditor believes he will not be able to rely on the internal controls to prevent material misstatements from occurring. So in that situation, the auditor would skip step 3 and move straight into extended substantive testing. Okay, so although generally speaking there are these 5 stages, sometimes step 3 is missed out. Okay, so I just want to make you aware of that. All right, so what I'll do now is go through each of those 5 steps. So the first step is client acceptance in the engagement letter. So to decide whether or not you're going to accept a client as a new audit engagement, you have to know something about that client. And you have to know whether, firstly, you're independent of the client, because if you're not independent, you're not allowed to do the audit. You have to make sure that the client is a kind of company that you're able to audit, that you have sufficient expertise in auditing. And you have to make sure that it's a kind of client that you feel is sufficiently trustworthy that you're willing to audit the client. Okay, so there are various considerations that go into deciding whether you're going to accept a client or not, right? It's about expertise. Can you do the audit? Are you independent of the client? And do you have sufficient trust in the client? Okay, so how do you obtain information to make those decisions? Well, you can obtain this information in various ways. The most common source of information is just meeting with the company's management and going and visiting the company, right? I mean, if nothing else, that proves that the company does exist, right? If it's a manufacturing company, for example, you can have a tour of the production facility. Okay, so meeting with company's management can give you some information about what kind of business the client is in. Why is the client looking to have an audit? Did it previously have an audit firm? And if so, why is there a change in auditor? And what are the key things that the client wants to get out of its audit? So that's the first thing. Secondly, you can contact the outgoing auditor and the company's advisors. Okay, so remember, we talked about this previously in the auditor independence seminar, that it's your responsibility as the incoming auditor to contact the outgoing auditor to ask them whether there are any circumstances that you should know about that would persuade you that you shouldn't actually do the audit. For example, if the client is engaged in a fraud. Okay, so you need to contact the outgoing auditor. Hopefully that auditor will tell you useful information. And you can also contact the company's advisors, right? So for example, if the company has an investment bank, if it's a company that is coming up for an IPO, for example, or it might be that the company's advisor is a law firm, right? You can contact the law firm and find out more information about the company. If the company is large enough to be covered in industry publications, you can read about it in that way. You can go on to Google and do a Google search of the company, have a look at the company's website, etc. You can look at the company's financial statements and disclosures. That's another important way to get information about the company. Okay. So those are some sources of information. Now, when you've decided that you are going to accept the client as a new engagement, then you need to write an engagement letter. And the engagement letter is important because that serves as your contractual agreement with the client. Okay, so as with any contracted service where you're promising to provide a service, you need to explain what you're going to do, right? So you need to outline the objective and the scope of the audit. So for example, is this just an annual financial statement audit, or will the client require you to also do interim reviews of quarterly financial statements? Does the client require you to provide a letter to the company's bank regarding compliance with loan agreements, things like that? All right. So there may be other demands from the client that go beyond just a regular annual financial statement audit. And so that information should be included in the engagement letter so that both parties know what it is that you've agreed you're going to provide, right? What's the service you're providing. Secondly, management's responsibilities. So this would include that management are responsible for preparing the financial statements, right? So management need to know that that is their responsibility, and the auditor's responsibility is to audit, not to prepare the statements. In addition, it may be that the client's management will provide some employees who are able to help the auditors to collect information. Right? So that may be one way in which the client can help reduce the cost of the audit. Right? So those client employees would not actually be doing audit procedures or any tests, but they may be like a gopher, right? They can go out and collect source documents on your behalf, right? So that's something that if you've agreed that upfront with management, that would want to be specified in the engagement letter. Otherwise, you might turn up at the client and you say to the management, hey, do you remember you said you'd give us 2 members of your staff to help us? And then management forget, right? So that should be specified in the engagement letter. Thirdly, the terms of the engagement, including a statement of unavoidable risk. So what's a statement of unavoidable risk? Well, it's a statement that even when you have completed the audit, there is always some residual risk that the client's financial statements could be materially misstated. In other words, you cannot provide absolute assurance that the financial statements are free of misstatement. Okay, so this statement is important because if the case ends up going to court, for example, if a client has a restatement due to a material misstatement that is later discovered, then this statement of unavoidable risk can help to protect the auditor, right? Because you can say to the court, look, we warned the client that we were not providing a guarantee that the financial statements will be fairly presented. Okay, and then the fourth part is remuneration. So there are 2 different types of remuneration schemes that audit firms will often use. One is a fixed fee arrangement where the auditor and client have determined the fee at the start of the audit before the work is done, and that is fixed in stone, right? It can't be changed. But alternatively, sometimes there's a flexible fee arrangement where the auditor will propose a budgeted fee, but then that fee will be altered depending on whether the audit goes over budget or under budget. Okay, so a flexible fee arrangement essentially puts the risk on the client because the client may end up paying a higher fee than it was expecting, whereas a fixed fee arrangement puts the risk on the auditor because there's a risk that the auditor might go over budget, but he can't increase his fee. Okay, so that needs to be specified in the engagement letter, right? Is it a fixed fee arrangement? Is it flexible? What's the amount? Who's going to be working on the audit? What's the number of hours from each member of staff that's expected to be working, etc. All right, so that all goes into the engagement letter. The second step is the audit plan, right? So whenever you plan anything, or whenever you do anything, for it to be successful, it needs to be planned out. So for example, whatever you do, if you're teaching a course, right, you can't just turn up and start speaking. You have to actually plan in advance what you're going to do. If you don't, it will end up being disorganized and chaotic and inefficient, right? And so that's what you want to avoid. So that's why you do a plan. Now, of course, to plan the audit, it requires knowledge and understanding of the client's business. Now, that may be fairly easy if it's an existing client, right? If you're auditing a client who you've already audited in prior years, then you can go back to previous years' working papers and the client's permanent file to find out about the client's business. If it's a new client, however, then that is more difficult, right? You have to go back to here and obtain the information from these sources, right? And when you're planning the audit. So that's a bit more difficult if it's a first-time client. It's a bit more difficult to plan the audit because you inevitably know less about the client. Now, within your plan, you should detail the scope, the extent, and the timing of 3 types of procedures and tests. So the first one is analytical procedures, second one is internal control tests, and the third one is substantive tests. So what are analytical procedures? Well, this is essentially where the auditor is analyzing the company's data, could be analyzing the company's financial statements, and what the auditor is trying to do is to evaluate what the risks are within the client's financial statements. Okay, so when we're talking about analytical procedures, we're talking about kind of data analytics here, right? That's what the auditor will do. And the auditor does these analytical procedures at both the planning stage and at the completion stage of the audit. It's done at the planning stage to try and identify potential risks in the audit. And then it's also done at the completion stage, because at the end of the audit, there could be changes to the client's data, because the auditor will likely suggest adjustments to the client's financial statements. So you need to do analytical procedures at the end of the audit as well, right? So that's a requirement of auditing standards, right? You do analytical procedures at the planning stage and at the completion stage. Then you have internal control tests, and the purpose of these tests is to assess the client's control risk. In other words, what's the risk that the client's controls will not prevent a material misstatement? And then you have substantive tests. So these are tests in which your auditors are trying to actually detect whether a misstatement has occurred, okay? All right, I'll talk more about the relationship between internal control testing and substantive testing later in the seminar. Okay, and then thirdly, the plan should include audit budgets and assignment of audit staff, right? So you should decide, you know, who is going to actually be working on the audit, how many hours do you think they'll need to work. You need to make sure you have staff at the appropriate level of expertise with the right amount of experience. So for example, a complex audit, obviously, you wouldn't want to rely mostly on inexperienced audit staff, right? Okay, the third step is to test and evaluate the internal controls. So remember, as I said before, that this third step is not always done, right? Sometimes the auditor may skip this step if, for example, the client doesn't have any internal controls. But assuming that this step is performed, what do the auditors do? Well, the auditor will test the internal controls in three ways. One is through client inquiry, one is through observation, and the third way is through documentation. So let me give you an example involving purchase orders, right? So a necessary control procedure for the client is to have independent authorization of purchases. Otherwise, for example, you could have employees who are purchasing items for their own benefit rather than for the company. Okay, so how would you test that particular control over purchase order authorization? Well, one way is through client inquiry, right? You just ask the employees at the company, who is it who's responsible for authorizing purchase orders? And then make sure that that person who has the authorization responsibility is not the person who's actually placing the initial purchase requisition, and is not the person who's actually going to be handling the item once it's delivered, right? Because otherwise they may be ordering it for their own use rather than for the company's use. Okay, so inquiry, asking who is responsible. Observation, so you can observe who prepares the purchase orders and who authorizes them. And then thirdly, documentation this is where you take a sample of purchase orders and inspect them to check for evidence of authorization. So the person who authorizes the purchase order should sign it or put their initial on the purchase order to show that, you know, they've checked it over before the purchase is actually placed with the vendor. Okay. So out of these three methods of testing internal controls, obviously the first one is the least reliable. Right? You don't want to rely only on client inquiry because you may not be told the truth. Observation is probably the second least reliable, because it may be that the control procedure is being performed when you are there observing what's happening, but maybe the control procedure is not being performed when you're not there. So out of these three, documentation is probably the most reliable, but any of these three can be included as a test of control. Now, when you test the controls, you have to consider the following three questions. How well are the controls applied? Are they applied consistently? And who applies them? So for example, if you take a sample of purchase orders and you inspect them for evidence of authorization, then the question, how well are the controls applied, would be what percentage of the purchase orders do show evidence of independent authorization? So if you find, for example, that 99% were properly authorized, then that would be a control procedure that seems to be working quite well. If it's only 50%, then obviously that control has a weakness. So that's the first question. The second question, are they applied consistently? So remember, you're auditing throughout the fiscal year. So you need to try and assess whether there are any changes in the quality of internal controls during the year. So it might be, for example, that the authorization of purchase orders is being done properly in the first 3 months of the year, but maybe the rest of the 9 months, there's nobody doing that job, okay? So, you know, it wouldn't be appropriate just to limit your test to the first 3 months of the year, because then you don't know that there's a change in control risk in the latter part of the year, right? So to answer this second question, you need to kind of do testing throughout the year. And then thirdly, who applies the control procedure? The question here really is about segregation of duties, right? So in the case of authorizations of purchase orders, you want to make sure the person who does the authorization is not the person who actually initiates the purchase requisition, okay? Because the whole point of having independent authorization is to prevent that person who makes the initial requisition from purchasing items for their own use rather than for the company. Okay, so who applies them? The question here really is about appropriate segregation of duties. Okay, number 4 is substantive testing. So substantive testing is when the auditor does tests of details relating to individual transactions or account balances. So if we're thinking about, for example, tests of details relating to sales transactions, is checking that the sale transaction actually did occur, right? That there were items that were ordered by the customer and the customer's order was fulfilled by the company and the amount of the sale was accurately recorded, for example, right? There would be tests of details relating to transactions. And then you can also have tests of details relating to account balances. So for example, a customer may have an account receivable balance showing how much is owing to the client, right? And so you can verify that amount by, for example, writing to the client, sending them a confirmation and asking them to confirm how much is owing. All right, so these are known as substantive tests. And the amount of substantive testing you do depends on your evaluation of control risk. Right? If you think the control risk is high, that means there's a higher risk of misstatement in the client's financial statements, then you need to do more substantive testing, right? Because you need to reduce the risk of not detecting a material misstatement. Okay, so what's the relationship between tests of control and substantive tests? Well, if you follow these arrows and these boxes, you can see what the relationship is, right? Well, how do the tests of control inform substantive tests? First question is, are there sufficient and adequate controls for reliance? So what this means is you want to decide whether the client has controls in place that you think you might be able to rely on. Okay, if the client says, if you ask the client whether they have specific controls in place, for example, do they perform an inventory count at the end of the year, and the client says, no, we don't, then that control doesn't exist, so you can't rely on it. So then the answer is no, you abandon the test of control. That is, you wouldn't attend the inventory count. Instead, you would just perform extensive substantive tests. Okay, so this first box is really about finding out whether the client says that they have the control in place. And is that a control you can rely on to reduce your assessed risk of material misstatement? So if the answer to that is yes, then you have to actually test the control, right? So you can't just rely on the client to tell you, yes, we have these controls. If the client says, yes, we have them, then you actually have to test those controls to make sure that they're working effectively. And then after you've done the tests, you have to make a decision about whether the controls are working effectively. So the question in the next box is the level of compliance sufficient for reliance on the internal control structure? When we're talking about compliance here, we mean the client's compliance with its internal controls. Right? So, for example, with purchase orders being authorized, we want to know, is the client actually complying with the authorization procedures that are set in place? Right? So the client says it has these procedures for authorizing purchase orders, but is the client actually complying with its own policies? Okay, so you're assessing what the risk is that the controls are not working effectively. If you find that the level of compliance is low, so control risk is high, in other words, then you move to the right here and you expand the range of substantive testing, right? So in other words, this is a situation where the client said, yes, we have the controls, you test them, you find the controls not working, so then you just expand the amount of substantive testing that you do. If the client is found to have low control risk, so in other words, the client is complying with the control procedures it says it has, then you can reduce your substantive tests, right? So this is where the client says, yes, we have the controls, you test them, you find the client is complying with those control procedures, then you don't need to do as much substantive testing. Okay, so that was the fourth stage. And then the final stage is audit completion and issuing the reports to shareholders. There are three main parts to audit completion. The first one is known as a subsequent events review. A subsequent event is an event occurring between the balance sheet date and the audit report date. Okay, and I'll talk more about this towards the end of the course when we have our seminar about audit completion. But essentially, there are two types of subsequent events. There's one type of subsequent event that provides information relating to conditions existing at the balance sheet date. And in that situation, you have to adjust the financial statements. You have to adjust the income statement and the balance sheet to reflect the effect of those subsequent events. So for example, if a client was being sued before the year end and then it loses the court case after the year end, and because the litigation was outstanding at the year end date, then you have to recognize the liability at the year end. Okay, so that's the first type of subsequent event. The second type of subsequent event is one that does not provide information relating to conditions existing at the year-end date, and in that case you don't have to adjust the financial statements. Instead, the company has to provide a disclosure in the notes. Okay, so that's just a very brief overview of your subsequent event review. As I say, I'll go into more detail about this towards the end of the course. The second part of the completion stage is to send letters to the lawyer and to the management. Why do you send letters to the lawyer? Well, this is part of your subsequent events review, in fact, right? Because often these subsequent events involve litigation. So you want to send the letter to the lawyer as late as possible in the audit because you want to find out the latest information before you issue the audit report. Right? Remember, subsequent events are any event occurring up to the date of the audit report. So you contact the lawyer towards the end of the audit to find out if there's any new litigation or any existing litigation has been settled. You also send a letter to management to tell them about what you found during the audit. For example, do you have any recommendations about improving the company's internal controls? And then the third step is to issue the audit report to shareholders. Okay, and this audit report will be unqualified if the auditor is reasonably assured that the financial statements are free of material misstatement. If, on the other hand, the auditor believes that there is a material misstatement in the financial statements, then the auditor cannot issue an unqualified report. In that situation, it will be a qualified opinion or an adverse opinion. Right? And again, I'll talk more about these different types of reports towards the end of the course. Okay, so that's where we'll finish this video. In class, the first thing we'll do is question number 1, which talks about reasonable assurance versus absolute assurance. Why are auditors responsible only for reasonable assurance, not absolute assurance? And then what are the differences in the auditor's responsibilities for detecting material errors versus material frauds versus illegal acts that don't actually have any financial reporting consequences? Okay, thank you for watching.